Good afternoon. My name is Tom, and we are excited to present to you today about mutual funds, the easy way to diversify. To begin, I'd like to introduce you to our team of professionals here today who are prepared to advise you on the nuances of this great investment product. Our presentation objectives are as follows: to showcase the advantages and disadvantages of investing in mutual funds, to differentiate the types of mutual funds, ETFs, and investment trusts, to then demystify the calculation of mutual fund returns, followed by classifying mutual funds according to investment objectives, and finally guiding the mutual fund selection process for you. Investing alone can be risky, costly, and complicated. Retail investors often overconcentrate into a few stocks or bonds, exposing themselves to high risk if one investment performs poorly. Researching and managing a balanced portfolio requires time, knowledge, and access to professional analysis. Additionally, building a diversified portfolio independently can be expensive, as multiple securities will incur trading fees and require large capital. Also, many investors can't access the institutional grade investments or management tools that optimize returns and minimize costs. To mitigate these barriers to entry in the investing world, we offer the solution: mutual funds, a one-stop shop for diversified investment portfolios, which may have been previously inaccessible to many investors. They're managed by professionals who handle the details. On the most basic level, mutual funds raise money from investors to then pool it together and invest it. These portfolios can be comprised of stocks, bonds, other investments, and even combine asset classes under one roof. Each investor will own a share of the fund that is proportionate to their investment amount.
Mutual funds are one of the most accessible ways for everyday investors to build a diversified portfolio without needing to manage each individual investment. Let's start with the advantages. Mutual funds give you instant diversification since your money is spread across many different investments. They're also professionally managed, meaning experts handle the research, buying, and selling decisions. You'll also benefit from lower transaction costs and easy liquidity since you can buy or sell shares at any given time, and the convenience of customer support and flexible options. There are also some downsides. Active funds often underperform the overall market, even though they're run by managers who try to pick investments that will outperform the market, but most fail to do so over time. After accounting for higher fees and taxes, studies show that around 80 to 90% of active funds earn lower returns than simple, low cost index funds that track the overall market. Fees and management costs can eat at your returns. And while diversification reduces specific risks, it doesn't protect against overall market downturns. And as well as taxes from fund activity can also impact your profits. Now, here's how mutual funds actually operate. If you look on the right, there is a simplified photo broken down. Multiple investors pool their money together into one large fund managed by professionals. Each of us, as investors, owns a proportional share of that pool. You make money in three ways: through dividends or interest from the fund's holdings, capital gains when investments are sold for a profit, and by the increase in the fund's overall value. Structurally, mutual funds are set up as corporations or trusts. Shareholders elect a board of directors, and a management company handles operations, as well as professional investment advisors managing the portfolio itself. In short, you're outsourcing the work of investing to professionals while still benefiting from the fund's growth. Here is a simplified example of what I just discussed. Now, where mutual funds fail, despite all those benefits, mutual funds do have their weaknesses, especially active ones. Like I mentioned earlier, research shows that over 80 to 90% of active US mutual funds fail to outperform their benchmarks over a 10-year period. What this tells us is that it's extremely difficult, even for professional fund managers, to consistently beat the market. Because of this, many financial experts recommend investing in low-cost index funds that simply track the market itself instead of trying to outsmart it. Now for investment companies. Mutual funds are actually one type of investment company, which is a broader category. Investment companies pool money from many investors and manage it professionally. Let's look at the main types. Open-end investment companies, better known as mutual funds, continuously issue and buy back shares. Their prices are based on the net asset value or NAV at the end of each day. Closed-end funds issue a fixed number of shares that trade on an exchange, so their prices fluctuate like stocks and can trade above or below NAV. Unit investment trusts, or UITs, hold a fixed set of investments for a specific period and no active trading. And REITs, or real estate investment trusts, let you invest in real estate without directly owning the property. Together, these give investors a range of ways to diversify their portfolios while matching different risks and return preferences.
Okay, so now we're going to move on to the types of mutual fund fees. First, we have commissions, which are fees paid when you buy or sell shares of the fund. There's a front end fee, which is charged when buying, and a back end fee, which is charged when selling shares. Next is the annual management fee, which is usually a yearly fee that is a percent of your investment paid to the fund managers for managing the portfolio. And lastly, the marketing expenses, which are fees used for advertising, promotions, and distribution of the fund. These fees are also included in the expense ratio. Now, load versus no load funds. A load is a sales commission charged when you buy or sell shares of a mutual fund, and a load fund is a mutual fund on which loads are charged. So in the chart below, we have the different types of funds when you pay the fee and some notes. So Class A is a front end load. Class B are back end loads. Class C's you pay at the purchase and sale price and sale, and no load is a $0 commission. So there's no sales charge at all. Now, mutual fund efficiency and costs. So first is the expense ratio, which is a ratio of a mutual fund's expenses to its total assets. And you're going to want to invest in a fund with a lower expense ratio. And within this expense ratio is a 12b1 fee, which are annual fees ranging from 0.25% to 1% of a fund's assets that the mutual fund charges its shareholders for marketing costs. And then the turnover rate is the level of funds trading activity. So when you have a higher turnover rate, the funds have higher expenses. And this is a measure of trading and not an expense. Now, how to calculate mutual fund returns. So some quick notes on returns is that they can come from dividends, capital gains, or change in net asset value. And you can also automatically reinvest your dividends and capital gains in order to buy more shares and help grow your investment over time. And calculating returns helps you spot the fund that have consistent winners over time. Below is the formula that calculates total returns, which we're going to use in the following example problem. So for this example problem, you're going to imagine you buy 200 shares at $50 per share. So your beginning net asset value is $10,000 and your ending net asset value is $55 per share. $2 in dividends and $1 in capital gains are distributed per share. So multiplying the $2 and the $1 by 200 shares gets you 400 and 200. And now to calculate the change in net asset value. So we ended at $55 a share minus the $50 at the beginning, which gives you a $5 gain per share. And the change in net asset value is $1,000. So now using that formula to calculate the total return, we have 400 plus 200 plus 1,000 divided by the beginning net asset value gives us a 16% return. So our ending balance is going to be that original net asset value times 1 plus 0.16 gives you $11,600 ending balance. Now we're going to continue and calculate the fees. So pulling some of these numbers from the previous slide, 10,000 and 11,600, as well as the 16% return. We are also given that expense ratio is 1%, and our 12b1 fee is 0.25%. So after calculating the average fund balance as 10,800, we are going to apply each fee. So the expense ratio fee is $108, and the 12b1 fee is $27. So we're going to take that ending balance before fees and subtract both of those fees, which gives us an ending balance of $11,465. Now in this next example, we're going to assume that our dividends and capital gains are reinvested throughout the year. So our initial investment again is going to be $10,000, and we're told that our ending value before fees is $11,340. Now we're going to use this simple formula of ending portfolio minus beginning portfolio balance divided by beginning portfolio to get the change. So 11,340 minus 10,000, all divided by 10,000, is going to give us a 13.4% change.
Okay, now I'm going to be speaking about money market mutual funds. These are funds that invest in low risk, short term debt securities such as T bill, muni bonds, corporate bonds, and they're designed to offer a more safe and stable investment option if investors need their money sooner. Short-term investments in these funds usually mature in less than 30 days, and then they have some other perks such as trading at a constant $1 NAV and having minimal expense ratios and carry loads, which are the fees associated with the upkeep of a fund. There are two different types of money market mutual funds, a tax exempt and a government securities fund. For tax exempt, these funds invest in securities issued by state and local governments. So most times the income from these is exempt from federal income tax. Generally, these offer lower nominal yield than the taxable funds. And then the government securities fund are considered the safest type of money market fund, and they invest in short-term US government debt and securities. So the income is taxable at the federal level, but for this one, not at the state and local level. And this one often has higher yields than the first. To get into stock mutual funds, these are funds that invest in a pool of shares of companies with varied aims to diversify. So I've included this table here to show the different types of stock mutual funds. As you go down the first column, you'll see different names and then risk, focus, and investor type associated with each. So for example, if you are a risk taker type of investor, then you would probably want to invest in aggressive growth mutual funds. So this would have high risk, but would be focusing on maximum growth. But let's say you're a passive investor and don't want to be on top of it as much and have different focuses, then maybe you would go for an index fund, which has market level risk and just focuses on tracking the market. So this is kind of a personality test in some ways of what kind of investor you are to find what kind of stock mutual fund would be best fit for your portfolio. To continue on, the difference between asset allocation and balanced mutual funds. Asset allocation actively invests in a mix of stocks, bonds, and money market securities and practices market timing. So the goal of an asset allocation fund is to move money between stocks and bonds depending on market conditions. So the portfolio composition is going to change based on how the market is doing. While a balanced mutual fund focuses on long-term growth and stability through common stock and bonds. So the goal for this one is to have steady growth with moderate risk. So the portfolio composition for this would stay relatively constant over time and not fluctuate as much with the market. And then finally, we also have life cycle and target retirement funds. So these are mutual funds designed to match investors' age, goals, and risk tolerance. They both adjust the mix automatically over time, depending on the investor age. However, life cycle funds focus more on the life cycle an investor is in when they begin the fund, and it shifts over time as they get older. There'll be a higher concentration shifted from stocks over to bonds, as this figure over here to the right shows. And then with target date funds, this would be designed around an anticipated retirement year. So this would be a fund such as Target 2055 Retirement Fund and just cater a little bit closer to the exact year that someone expects they're retiring. But as you can see on the figure on the right, as time goes on and an investor gets closer to retirement, they're going to dilute a little bit more out of stocks and into bonds for more security.
I would now like to introduce you to bond funds. These are mutual funds, which, hence the name, invest primarily into bonds. First and foremost, they're low volatility. Their value really only fluctuates by interest rate changes and not by much. They are safer, but less liquid at the same time. Many of these instruments require you to lock away capital for several years, so we recommend committing a smaller portion of your investable assets for this fixed return. Finally, they're low maintenance. These bonds are mostly passive, hands-off investments. And in that sense, individual allocation can also be feasible to avoid fees when these aren't being very actively managed. These can come in any form, in short term, 1 to 5 years, intermediate, which is 5 to 10, and long term, which is 10 to 30. The primary types of bond funds are going to be U.S. government bond funds, which invest primarily into treasury securities, which are fully backed by the faith of the U.S. government, offering great stability, liquidity, and low credit risk, but at the same time, very low returns. Moving on, we have GNMA bond funds, which are mortgage-backed securities which are issued by the Government National Mortgage Association, Ginnie Mae. They're backed by the U.S. government and they have therefore guaranteed principal and interest payments, and they provide higher yields than treasuries. Next, we have municipal bond funds, which invest in bonds issued by state and local governments. These offer tax-exempt income for investors in higher tax brackets while funding public projects like schools, infrastructure, etc. And the option to be tax deductible is attractive for many reasons. Finally, we have corporate bond funds. Here you can buy debt issued by corporations, balancing higher yields with greater credit risk. This also provides investors with an income which is linked to performance and economic conditions, which they may be keen to. Moving on from bond funds, we have exchange traded funds, ETFs. This is the bridge between individual securities, stocks, and mutual funds. I'm going to go through some of the primary features of ETFs and what it looks like for their counterpart in mutual funds. First of all, they're highly liquid. They're traded on the open market and can be bought and sold as many times throughout the day as possible. Investors may buy in at any time without restrictions on how long to hold, and they can also buy on margin or sell short. Mutual funds are not publicly traded and only permit purchase and sale after market close, and you cannot, in most cases, buy on margin or sell short. ETFs are characterized by mostly low fees. There's definitely less annual management charges as far as expense ratio, but the brokerage or trading commissions do apply. Mutual funds, on the other hand, charge 50 basis points to 150 basis points in expense ratios, but without trading costs. There can also be possible loading fees, as we discussed earlier. ETFs are almost always open-end. These mean new shares are created upon the purchase, and the shares are redeemed when sold. These shares are created in large blocks by authorized participants exchanging in-kind securities for these new shares rather than cash. On the other hand, mutual funds transact with investors directly in cash, which may require the purchase or sale of holdings upon redemption. ETFs are also more tax efficient. Investors only realize their capital gains when selling their own shares and have that control over when taxable events happen. On the other hand, mutual funds can owe taxes when other investors redeem, and the fund has to sell holdings, as we discussed before. Next, the pricing. Exchange traded funds are priced at the market share. Share values are determined by supply and demand of traders throughout the day and are influenced by the stock market. Whereas mutual funds just trade at the net asset value and don't worry about these fluctuations for the most part. Finally, ETFs are typically passively managed. They usually track an index, a theme, or a basket with low portfolio turnover, i.e., lots of trading. Mutual funds, on the other hand, are usually actively managed, trading more frequently to try and outperform a benchmark, hence the higher portfolio turnover and usually tax burden. These ETFs come in wide varieties. They allow individuals to invest directly into an industry, region, or theme of their choosing, which is why they're so attractive to many typical investors. This is suitable as it is very capital intensive for a retail investor to research, purchase, and manage all of these underlying assets separately, not to mention rebalancing. Additionally, Investors can gain access to some more niche markets and securities that they otherwise would not, such as different countries or asset classes. Finally, fund composition and weighing is openly available from the manager. So all of this is disclosed, and you can see which stocks really are comprising the most weight in these indexes and what you're truly getting exposure to. The graphic on the right shows the biggest ETF for every sector, and you can see that on a very basic level, every sector is represented by an ETF, but these definitely get even more in depth as you look, and there really are countless ETFs to choose from.
Mutual funds provide various services that are advantageous for the investor, some of which include automatic investment and withdrawal plans. So instead of the investor manually moving their money in and out of the account, they could set a fixed schedule, which is great for the longevity of their wealth. Another automatic service includes reinvestment of interest, dividends, and capital funds. This allows the distributions to reinvest instantly and compound without any effort from the investor, really. Express options for wiring and funds allows investors to access the cash rapidly instead of waiting for those slower processes like mailed checks. And another service that increases the time efficiency is online and phone switching. So investors have that flexibility to move their funds electronically without paperwork or delays. More services include easy establishment of retirement plans. So for those who may have less financial expertise, this is particularly beneficial because it makes retirement so much more accessible by streamlining IRAs and employer-sponsored accounts. Additionally, check writing. Some funds even allow you to write checks directly from the mutual funds, giving them increased liquidity and spending access. Finally, something that's particularly great about mutual funds is bookkeeping and tax help. So this reduces a lot of that error when it comes time to paying your taxes because the mutual funds are tracking your purchases, sales, dividends, capital gains. And for a lot of investors, it eases the burden of having to keep track of all of these aspects. Now that you know all about a mutual fund, we'd like to conclude the presentation by teaching you how to buy a mutual fund and breaking that into 4 steps. The first step is personal. You need to determine your goals. Your goals encompass what the money is for. Is it for retirement? Is it for a house payment? You decide that because it's going to guide a lot of these other decisions. For example, your time horizon, how long your money will be invested. If it's short horizon, maybe you want less risk, or if you're comfortable with risk, which ties to your risk tolerance, you can have that longer horizon with more growth potential. Decide whether you're investing through a tax-advantaged account like a 401k or an IRA. Some reasons you might not want to do that is because there are increased regulations, penalties for withdrawal if it's early, things of that manner. Finally, acknowledge your risk tolerance and make market choices in accordance with that. Understand what you're comfortable with, taking more risk, having a long time horizon, or, you're not so comfortable with risk and you'd like your money to be in there for less time. Step number 2 is meeting your objectives. You need to identify the fund type. Maybe it's a growth fund and your money's going to grow over time, or it's a balanced fund, which mixes stocks and bonds for that increased stability. Identify what the fund is and will that match with your goals that you've established from step number 1. You can find a lot of this information in the fund's stated objective. So this is an official description of its purpose and what the manager aims for this fund. Check if the fund aims for capital growth or steady income. Compare the risk levels of each classification to your own risk tolerance and make sure the fund strategy aligns with your time horizon. That would be horrible if you have a short time horizon, but the fund's objective is for the long term. Step number 3 is selecting the fund. It's not just enough that your goals align with the fund's objectives. You need to check for consistency over multiple years. Make sure the fund has performed well over multiple years, not just 1 year or a month. Make sure that it still aligns with your goals and you're putting your money into something that will give you the return that you want. Also, examine the cost and fees carefully. And if you want the best advice, follow Dr. Tai Su's recommendation with a low-cost, passively managed broad market index fund. They offer diversification, low fees, and strong long-term performance, which is especially smart for beginners because it doesn't require you picking individual stocks. It has low fees, it's easy to maintain, and so it's a simple, low-stress way to start investing. The S&P 500 index or Vanguard, Fidelity would be great places to start. Finally, make the purchase. You're going to buy directly from the fund company using their website or by phone. Or another way is to buy through a mutual fund supermarket or brokerage. These are companies like Fidelity, Charles Schwab. They let you buy the funds from different companies in one account, and it makes it easier for you to compare and manage. Thank you for listening, and we are now open to any questions.